Imagine waking up tomorrow and hearing that your bank might run out of money. What would you do? Millions of people rushing to withdraw their savings at the same time. It's called a bank run. And when it happens, even perfectly healthy banks can collapse in a matter of hours. We've seen it throughout history, from the Great Depression to modern banking crisis, where billions of dollars disappeared virtually overnight. But here's the real question people never ask. Why do bank runs happen in the first place? And could it happen again today? Let's break down exactly how bank runs work, why they spread so fast, and what it means for your money. Here we go. Most people assume their money is sitting safely in a bank account. But what many people don't realize is that banks don't actually keep all of your money in the vault. In fact, most banks only hold a small fraction of deposits in cash. The rest is loaned out, invested, or used throughout the financial system. And normally that system works just fine. But there's one scenario where it can break down very quickly. It's called a bank run. And when it starts, it can spread faster than almost any financial crisis. So what exactly is a bank run? And what happens when everyone tries to withdraw their money at the same time? Let's break it down. First, it's important to understand how banks actually work. Banks operate using something called fractional reserve banking. That means when you deposit money into a bank, the bank doesn't keep all of it sitting there. Instead, a portion of that money is held as reserves. The rest is loaned out to borrowers. For example, when someone deposits $10,000 into a bank, the bank might only keep a small percentage of that as available cash. The rest could be used to fund mortgages, business loans, credit cards, and other investments. This system allows the economy to grow because banks are constantly circulating money, but it also creates a vulnerability. If too many people try to withdraw their money at the same time, the bank simply doesn't have enough cash on hand. And that's where bank runs begin. A bank run usually starts with fear. Sometimes it's a rumor that a bank is in trouble. Sometimes it's news about financial losses. Or sometimes it's panic spreading through social media. Once people start believing their bank might fail, they rush to withdraw their money before everyone else does, because whoever gets their money out first wins, and whoever waits too long might lose access to their funds. That's why bank runs can escalate incredibly fast. What begins with a few worried customers can quickly turn into thousands of people lining up outside a bank. History has seen several famous bank runs. During the Great Depression in the 1930s, thousands of banks failed across the United States. People rushed to withdraw their savings. Crowds formed outside banks. And many institutions simply ran out of cash. More recently, in 2008, during the financial crisis, there were major concerns about bank stability. Hey, real quick, I want to take a quick break and throw this idea out. If you would like to take advantage of the coming crisis in real estate, I put together a package of 4 courses. The Real Estate Crash Course that shows you the cycles of real estate, what to do during a bear market, how to sell the properties, and so much more. The link's down below if you want to take advantage of buying all 4 courses for a crazy price. Now, back to the video. And even in the modern era, we've seen bank runs triggered by digital withdrawals instead of physical lines outside buildings. In today's world, panic can spread even faster because withdrawals can happen instantly online. Billions of dollars can leave a bank within hours. When a bank run begins, banks often take emergency measures. They may limit withdrawals, they may temporarily close branches, or governments may step in to stabilize the system. Central banks can provide emergency liquidity. Deposit insurance can help reassure depositors that their money is protected. In the United States, for example, the FDIC insures deposits up to a certain amount. The goal is to prevent panic from spreading throughout the entire financial system. Because if enough banks experience runs at the same time, the crisis can quickly spread across the entire economy. And this is why confidence is so important in banking. Banks rely on trust. As long as people believe their money is safe, the system works. But if confidence disappears, even a healthy bank can suddenly face enormous pressure, because no bank can survive if everyone withdraws their money at the same time. The good news is that modern financial systems have safeguards designed to prevent widespread bank runs. Deposit insurance, central bank support, and financial regulations all help stabilize the system. But history shows that panic can still occur, especially during times of economic uncertainty. And understanding how bank runs work can help people better understand the risks within the financial system. The important takeaway is this: a bank run isn't always caused by a bank being insolvent. Sometimes it's simply caused by fear spreading faster than the system can handle. And when confidence breaks down, the financial system can become extremely fragile. So the next time you hear about a bank run in the news, you'll understand what's actually happening behind the scenes. It's not just people withdrawing money. It's a sudden loss of confidence in the system itself. And in finance, confidence is everything. If you want more breakdowns of how the financial system really works, make sure you subscribe. Because the more you understand the system, the better prepared you are when the economy starts to change.